Hello everyone, I'm Marty and welcome to the February 2023 market update. I know I've been getting emails and calls. You guys want this data, you want it right now. So I'm jumping on early and getting you all the data to bring you guys right up to date. So firstly, let's look at my table where I tabulate all of the data to look at all of the product for Greater Vancouver in a snapshot. So for detached houses, interestingly enough, we see the sales activity is down 53%. We see the benchmark price from this time last year for detached houses, Greater Vancouver, down 9.1%. Significant. Benchmark price in the last month only, 1.2% drop. So we're starting to see that steepen slightly on the detached. Attached townhomes and duplexes for Greater Vancouver, the activity is down 55% from this time last year. Prices are down 3%. You'll notice a bit of a change here, a bit of a crossroads, down 3% year over year for townhomes and half duplexes, and the benchmark price dropping last month by 0.8%. Not a significant drop, and there's a reason for that. Attached apartment condos, Greater Vancouver, activity year over year down 57%, significant drops in activities in all product types, and price year over year for the first time yet has dropped below the year over year. So a year ago, the prices for attached condos was about the same as it is now, only down 1.1%. You're going to start to see that change. And last month, prices jumped up 1%. So what's going on? And there's an answer for that. There's been a bit of a rush on entry-level activity. If you want to see some great examples, look just below me here in my sales reports if you're on YouTube, and look at the chest sold report that I did a couple days ago on our last 3 sales last week. Incredible activity on product under $1 million. Quite interesting. Why is that happening? So you'll find out. So let's go right on to what's hot and what's not. Let's jump into each product category. And the metric I use, as you regular viewers know already, is called the sales ratio. And all the sales ratio is the absorption rate of product into the market on a monthly basis. If it's over 21%, we've got upward pressure on prices, and 21 out of 100 homes are selling in a given market. If it's between, and that's what we call a seller's market, if we're between 12 and 20, it's a balanced market. It's not really favoring the buyers or the sellers. But if we drop below 11% absorption rate or sales ratio on a given month, we are in buyer market territory, and there's downward pressure on prices because there's more product than there are buyers buying up the product. Okay, so that's the metric we're looking for, 11, 12 to 20 and over 21. Let's first look at detached houses, Vancouver West Side. Now, if you remember my data over the last year, we hit a peak of 21% sales ratio for detached houses on the West Side. Very interesting. What happened last month? We're actually way down at 5%. That's a drop from 10% last month. Now, over the last 30 days, it's down to 5%. And that is definitely buyer's market territory. So if we look at condos, townhomes on the west side of Vancouver, we can see the peak last year. Again, we had that March-April peak of 2022. Sales ratio was at 56%. Last month, we had 20%, just below that seller's market border. And this month, we're at 15%. So it has, of course, dropped further down into that balanced market territory for condos, townhomes, west side. And if we go into condos, townhomes downtown, we break that out separately. We saw the peak last year was at 42%, tied for March, April in 2022. This month, we're at 13%. That's down from 17% last month. So we are in balanced market territory for condos, townhomes downtown. Let's pop over to the east side now. Let's look at houses. Last year, if you remember, in April, we hit 40% sales ratio. Last month, we were down to 14% in that balanced market territory. This month, we are at 11%. So we've just snuck under that boundary into what we call buyer's market territory. Some more downward pressure on pricing. Detached houses, Vancouver East Side. Wow, that's changed. If we look at East Side condos and townhomes, we look at last year, I don't know if you remember, but we were at 75% sales ratio. There were hordes of people climbing over each other at the open houses in the East Side for condos and townhomes. There just wasn't enough product that came in the market. Last month, we were at 21%. And of course, this month, we're down at 16%. We are now in balanced market territory. We've dropped into that balanced market territory. In the burbs, the data isn't out to show you all the fancy little circles for all the areas, but if we look at detached houses, the sales ratios have dropped. If we look at attached, under $1 million, there's been a flurry of activity. Over, we're seeing the sales ratios down. So that's typical across BC. The home sales, the blue line, you can see the activity is way, way down. The new listings are starting to creep. This graph doesn't show that yet, but we've got some new stats, so we can see that. The sales to active listings ratio, of course, from our peak in March, April is way down. Many of them in buyer's territory now, buyer's market territory. And of course, the sales activity across BC is down. Now, what's happening with prices? So here's one of my favorite historical graphs since 1977, showing the average price of different product in Greater Vancouver. For houses, we can see the average house price in Greater Vancouver is at $1,911,000 now, and you can see that sharp drop, a little bit of a jump in September, but since March, April of last year. Townhomes, the average price in Greater Vancouver is $1.229. That's been kind of jumping up and down, and condos are down to $758. So that's kind of an interesting view of that last 50 years. And then the average MLS residential price across BC, of course, since that spring peak has dropped as well. Now, what's going to happen? The big forecast. Nobody can say for certain, but here are the drivers that I'm watching. We've got market enhancers in green and market deterrents in red. So if we look at the one main market enhancer that I've been saying for the last 18 months, that's been holding that price drop steady at a reasonable rate, has been inventory levels. The low inventory levels still persist, and that's keeping the prices from falling steeper, but we're beginning to see inventory increase in certain areas. So it's just the start of that. The deterrents, of course, consumer confidence. I've changed from an orange to a red because we are looking at sellers beginning to list their properties, which will change this inventory, and buyers are getting to become less confident in our market with the oncoming talk getting greater and greater of recession, et cetera, and inflation isn't letting up much. We'll talk about that as well. It is still not under control. It's dropped slightly. January 25th, Tiff Macklem, as you remember, raised the rate again, 25 basis points. And there might still be increases, even though they're saying we probably won't, but we might. They're keeping that door open, so we don't really know what's going to happen there. And of course, that directly impacts the cost of borrowing, and the mortgage rates have risen to a point now where homeowners with variable rate mortgages and lines of credit that are tied to prime are suffering and will not be able to withstand the storm and might need to sell. And we're going to start seeing that coming in the market soon. So those are the things that we're watching. Consumer confidence, as I mentioned already, has dropped, and the economy, in order to have a recession, it needs to have 2 consecutive quarters of negative growth to say we're in a recession, but there are other factors. One of them is unemployment levels, and another is consumer confidence. And what's been remarkable about where we're at now is the unemployment levels haven't really taken off, but again, we're starting to see a change in that. I'll show you a piece of data shortly. Here, unemployment rates. You can see on my last graph, it was 5% for Canada. It's actually jumped up to 5.8. So we're starting to see that creep up. BC is the same for now. And why is that? Well, there's things like Google laying off 12,000 people across the board in their company. That's a major impact on employment. A lot of the high-tech companies they fluctuate dramatically depending on the economy, but that is going to impact our unemployment rates. We're reading articles like this: Canadian economy is slowing as the Bank of Canada hikes interest rates. And this one out yesterday from the morning update at the Globe, that Canada's economy loses momentum as the rate hikes take hold. So we're starting to see these forecasts now of these recessionary periods. So I found this graph, and I thought this was really cool, showing when the expected recessions are supposed to hit various countries. Well, the US and Canada are, of course, pretty tied together in our economies, as being neighbors, etc. And they're predicting that recession to hit in the third and fourth quarter of this year. And we can see, of course, Europe, Germany, France, Italy, and Britain not doing well. You're reading about the UK in the news all the time with their economy and the troubles that they're having. And then, of course, other countries there. This is the main one that, of course, we're watching. When is this expected to hit in Canada? And it looks like it might be around that third quarter in July. Okay, so that's interesting. Other news coming out about the U.S. government hitting their legal limit on their debt. That's kind of interesting. Wow, what's going to happen there? $31 trillion, not chump change. Inflation. So there's my friend Tiff Macklem. And of course, as we all know, January 25th, he raised that overnight rate another 25 basis points. So this is the highest rate the Bank of Canada has been since 2007, the overnight rate. And of course, that gives us a total increase in that rate of 4.25 percentage points in the last year. Very significant. And one of the things that I like to be aware of is why the government's doing that. And they're doing that for various reasons. Of course, you've got to get inflation under control. But one of the things that the government worries about is the wage price spiral. And what that means, if workers try to recoup lost ground because things become more expensive and their wages increase, what that does is they start to spend again with the increased wages that they have, and prices then catch up. And as the prices increase, they want the wages to go up again. So you have this battle of the consumer price index bringing up wages, and they call that a wage price spiral. So if it gets out of control, we have what we call entrenched inflation. Now, I'm not an economist, but entrenched inflation doesn't sound good to me. It sounds like things get out of control and you're going to be pushing shopping carts of dollars around to go grocery shopping. And that's kind of what was happening. Here's the consumer price index, and here is the average hourly wage growth. And we've seen that year over year catching up. So, wow, they're watching these things, and that's why they've had to raise the rate. So I thought that was kind of interesting. Retail sales in BC, of course, are continuing to increase, and that's feeding inflation. This is an interesting graph that I was able to download from the Bank of Canada site, just sort of showing here's where they want inflation to be, between 1% and 3%, hovering around 2%. And you can see what happened in 2021 where it got out of control. Here's where we hit that peak last summer, and it's kind of jumping around just below 7% now. They want to get that back down to 2 to 3% if possible. So that's really interesting. And then here's how Canada fares, sort of with a few other of the larger countries. Poor Italy, they're at 11.8%, Germany at 10.3%, Great Britain, if I recall, at 9.6%, and we're hovering around the high sixes somewhere. France a little bit below us, and Japan doing really well at 3.7. So that's interesting. The cost of borrowing. Now, borrowing is a big factor in determining the strength of the market. If it's harder for people to borrow money, it's going to negatively impact pricing in the market. And of course, one of the things we look at is the Office of the Superintendent of Financial Institutions. So that's called OSFI. And they're proposing even more stringent restrictions on lending. They're proposing three things. Number one, new restrictions on mortgage size and debt load. So they might limit the debt load that you might be able to carry. So that could make it difficult and could impact anywhere from 5 to 10% of the borrowers out there. Significant impact. They might introduce new debt service coverage restrictions. So again, your debt service ratio is what they use to determine how much you can borrow. And if they start to limit that, that's going to impact borrowers as well. And they might also propose new interest rate affordability stress tests. So that means you might face a different stress test or interest rate stress test for a 1-year mortgage versus a 3-year mortgage versus a 5-year mortgage. So they're trying to make it more difficult for borrowing money. Definitely going to impact our market as well. So here are the overnight increases since they began in March of last year when the market was on fire. They jumped up. They started to get a little more aggressive as they went into the summer. Jumping up at 1% was our biggest increase in July 13th, and then down to 0.75. And the last one, of course, in January, 0.25% or 25 basis points. That's the highest level since 2007 and the 8th consecutive rate hike in the last 11 months. Very interesting, very aggressive campaign. You can see, of course, how that's impacted the fixed and variable rate mortgages. The variable rate mortgage holders are, of course, looking at their trigger rates. I've got a great fireside chat on that you can listen to or watch. Really good information in there. And of course, there's been a lot of pressure on OSFI to relax the stress test, but they're remaining unchanged. In fact, as I just mentioned in the previous slide, they're thinking of increasing that. And Jay Powell, chair of the U.S. Central Bank, says that he will slow the pace of rate increases, but they're not closing the door and saying, no, they're done. Everybody's keeping that door open because they're looking at the data and they're making sure that they're doing the right thing. They don't want to overshoot too much to throw us into a deep recession, but they're trying to do enough to tame that inflation. So it's a real dance that's taking place now with the banks. So they're thinking if you could forecast rates, probably 2024 we might see some relaxation, but the government's going to be extremely sensitive and acting too quickly. Financial Times had an article out recently where the Fed rate said it might peak to 4.9% in the first half of this year and then fall to 4.7%. But the majority of members of the Open Market Committee believe that the rate could hit 5%. Or more this year. And of course, we're impacted what happens down south as well. And of course, Jay Powell said, history cautions strongly against prematurely loosening the policy. We will stay the course until the job is done. The Fed doesn't wish to repeat a mistake they made earlier. And what they're saying is, reading between the lines, is even when inflation starts to come down, sorry for you guys, when inflation starts to come down, they're not going to start relaxing that overnight rate yet and bringing it down. They're going to be very sure that things are under control before they drop the rates. And what I see, again, trying to interpret that, is 2024, we might see some softening, but it's not going to be dramatic. We're not going to see those rates come down anytime soon. Now, this is really, really interesting. Some interesting stuff done by TD Economics, gathering some data. What they're talking about is the amplified impact of rate increases in Canada. Now, what does that mean? That there's a difference between mortgage holders in Canada and mortgage holders in the US. American mortgage holders are skewed to a 30-year fixed rate that helps insulate them from renewal risks, where Canadians usually renew every 5 years. So many Americans, by the time they have to review, this whole inflationary high mortgage rate thing might have passed and things might get back to normal. But Canadians have a lot shorter terms, and that amplifies their risk, plus the fact that Canadian mortgage holders, more than 34% of them are holding variable rate mortgage, which are tied to prime. So they're even more impacted by rate increases. Now, and so we're at 34% variable rate mortgages now compared to 25% in 2018. So that's increased dramatically. What does all this mean? This means that the percentage of disposable income, the household debt service ratio, so what percentage of your income is being used to service debt in Canada, is at 16%. In the US, following the 2007-8 savings loan crisis, that dropped. See, here's where that happened, and things started to get under control. People learned a good lesson down there, is down to 10%. So we have, in Canada, a 60% higher household debt ratio. What that means, and also because we renew much more often in Canada than they do in the States, these rate increases are impacting Canadians much more than they are Americans. So if we look at this graphically, this is really scary. The purple bars are the actual overnight rate increases, and you can see here's the overnight increase in Canada. But if you adjust for the debt increase amplification of our Canadian mortgage holders, you can see that 4%, or we're at 4.25% increase that we've recently seen, is amplified to over 11%. So it's almost 3 times more impact on an actual adjusted rate increase in Canada than we would have seen if we were perhaps a US consumer. So, or mortgage holder. So very, very interesting. That's why these marginal rate increases are impacting us so much more dramatically than we thought. I thought that was really cool, really interesting data. So Bank of Canada, of course, is saying that this dip in prices is being impacted by the increased rates, and they're predicting home prices will decline. Well, that's no surprise. That's already happening. And we're reading more and more of this every day. Now, that, of course, has been somewhat softened because the last thing I talk about that we're tracking is the inventory levels have been historically low. So this was also a very interesting discussion that Benjamin Tull did from CIBC. He says this is the first actual adjustment in prices where the inventory, the supply of resale units is actually down. And you can see back here, 2007-8, it was higher in 89, 90, and 2017, 2018, we had really, really high increase, percentage change in new listings. Now we're way down, and that's insulating us from the prices falling steeper. It's very, very interesting. So far it's worked to limit the magnitude of the price decline, and as I said many times before, and this is really a neat way of looking at it, the low inventory has saved us from prices falling even steeper. So that was a really interesting thing. Of course, active listings are starting to climb in all areas. If we look very locally here, just to the west side of Vancouver, you can see for houses, you can see for the first time in quite a while, the inventory went from 403 houses to 455 houses on the west side. Is this the beginning of a trend? We'll see. Vancouver west side condos and townhomes. Look at how steady that is. And then it even went down back in December, which is typical. It's cyclical to go down in December. We've had an increase up to 513 in the last month. So we're starting to see that inventory increase. What does this mean for prices? Where are prices going? Let's talk about that. Of course, from our peak in spring, prices have been softening. This is kind of an interesting piece of data that Scotiabank put together. And they came up with a relationship. Home prices have fallen in markets with bigger pandemic booms. So they're relating to the to peak pandemic pricing change in certain cities compared to how prices have fallen. And what they're saying is the more prices increased during that pandemic boom, the more they're falling now. So you can see Hamilton, really interesting, had a 70% increase in prices, and prices are down already by 18% in this correction. And if we look for Toronto, they were almost at 60%. They're down already 12%. Now, this is back in November, so this data is a little older, but it shows a correlation and how volatile those markets are. The more volatile up, the more volatile down. Greater Vancouver, of course, we had over 30%, and at that time, we were down about 7-8%. Of course, we're down more now. But that kind of shows the more volatile the prices are in a particular city, the more we can expect prices to fall. So I thought that was kind of interesting. What's the forecast? What's going to happen? Let's talk about that. Basically, here's the HPI housing price index that I follow. That's September 2021, when prices started to take off in the fall of the previous year. It hit that peak in March, April of 2022. We started to see a bit of softening, a little bit steeper, and that's gotten a little bit steeper now. And you can see how that's changed since that peak. And the factors that are the cause of this, of course, as we've talked about in detail, are the interest rate increases, the consumer confidence is falling, the BC cooling off period that started in January 1st is not helping, and the federal ban on foreign home buyers on January 1st is also impacting our market. And the economic uncertainty, which is tied into consumer confidence, is also impacting it. And the one thing that now I've changed to turn into that sort of soft orange color, if that's what you'd call it, is the listing inventory surge. There has not been a surge yet. The inventories are still very low, but it looks like they're starting to change. That we'll see. And if it does, then we're going to see this curve even drop a little bit sharper. Okay? So that's kind of interesting to look at in conclusion. We're soon entering into this recessionary period that everybody's been predicting. Consumer confidence is falling. People are kind of hunkering down a little bit and getting ready for this. The high mortgage rates are beginning to take their toll on mortgage holders, and there's no short-term relaxation on the horizon. We're not going to see rates fall in the next few months. It's going to be a while, as we talked about. So that's starting to happen. Inventory levels and active listings are beginning to rise, and the rate of price decline will likely steepen the more product that comes onto the market, okay? So it could be another 10, maybe 20% drop this year if I was to pull a number out of a hat. Nobody can tell the future, but that's kind of the way things are shaping up, okay? That's my market update. I also keep you informed in other formats. Again, on YouTube, we've got all of our updates and just sold reports. We've got our fireside chats on there. So visit our YouTube page and subscribe so you'll get notification when the new videos come on. And of course, we're doing all our podcasts on Apple Podcasts, Spotify, and Google Podcasts. If you'd rather listen to me ramble on when you're in the gym or drive to work, they're available there as well. And that's my February 2023 market update. Whew, a lot of stuff to cover. I hope you enjoyed that. Again, you can follow the videos on YouTube, Facebook, and Instagram, and the podcast on Apple, Spotify, or Google. Thank you very much. I'm Marty Pospisil. You guys have a fantastic February. If you have any questions, pop me an email. Happy to answer them.